Okay, the next earning date for Alibaba is scheduled for November 3rd. So by November 4th, we should have results. Based on the past, it's never really moved more than 10% on an earnings play over the next day. So I would place my upper limit at 185, 186 here, and my lower limit here at resistance at 167. So I don't think it's going to move lower than 167 or higher than 185 after earnings results, and most likely it'll be in somewhere in that range. The way you could do that with stocks, I already showed you. If you invest in the stocks, you have possibility of making 5% or 6% if it goes up 6%, but on the other hand, you have a possibility of losing 5 to 6% if it goes down. So your risk and your reward are 1 to 1. What you want to do is get an asymmetric risk reward where your risk is less than your possible reward if you're right. So one way to do that is with an option play, and I'll show you what that is. This is one that I put together, and it involves buying 10 options, the right to buy it off somebody at 175, and being willing to sell it 20 times that number of contracts, double that number of contracts, at 190. Now, I'm going to show you the different risk reward on that. So basically, to the downside, first of all, this will cost you an initial cash flow of $3,800. And it requires that you have 27,000 of, let's go down to something that you can afford. Let's put something, I'm going to go with small amounts here, and we can scale up, knowing that we can do any multiple of these. Okay, so if you do just one contract like that, your downside risk is $350 if the stock moves lower. And I need to move the date here to the date after earnings. This, I believe, 17 days away, so 18 days is the day after earnings. There we go. So here it is. This is your risk-reward relationship. So if the stock moves anywhere between 2% higher and 14% higher, you are making anywhere from, let's talk in terms of your downside risk, anywhere from a 10 to 20 to a roughly 3 to 4 times your risk, 3 to 400% on your risk. However, if the stock moves beyond higher than 14% by the day after earnings, you could start losing much higher values. As you see, if it moved up 25%, you could lose $2,000, which is 7 times what you're risking. That's one way to play it. So if you're wrong, not much downside. If you're right, really nice multiple. If you do it more conservatively, this is what you get. One way of doing it. So for every $800 that you put at risk, maximum loss of $800, your gain on a 5% move, that's the average move it gained to the upside, would be $900. So it's a little bit, it's about 110% of what you invested. Of course, if it goes up a lot, like 10%, you could make around $2,700, which is, excuse me, I need to adjust this. Okay, at 20%, excuse me, at a 10% move, you'd be looking at about, right around $1,800 of profit, which is about double your risk. So this is an asymmetric risk-reward relationship. You have a defined loss and you have unlimited profits above a price of 3%. And the final way to do this is if you think it's going to move at least, say, 5%, then you could do something like this. In fact, I think there, for every $260, $290 you have at risk, your reward. All right, for every $294 you have at risk, it requires, for you to really make a lot, the maximum amount of money you can make is about double what you risk, 2.5 times what you risk, around $700. But you start making money at a move of about 4 or 5%. You make no money, you lose money under a 5% move. So those are different option plays with asymmetrical risk-reward relationships. I hope that makes sense. I'm going to stop this little recording.